The general sentiment overnight has been a nuanced one. While some of the broader market indices are showing a fractional softening in futures, suggesting a moment of pause after recent runs, the underlying currents are anything but still. We're witnessing a delicate dance between robust corporate earnings from certain sectors, the lingering uncertainty surrounding global inflation, and the ever-present geopolitical backdrop. But towering above it all, casting a long shadow or a guiding light, depending on your perspective, is the monumental shift in leadership at the Federal Reserve. This is not just a change of guard, it's potentially a change in the very philosophy guiding monetary policy. This morning, the whispers from Washington are turning into definitive pronouncements. The Senate has passed a spending package, but the specter of a partial government shutdown still looms, an unfortunate backdrop against which the new era at the Federal Reserve begins. The most significant development, of course, is the confirmation of Kevin Warsh as the new Federal Reserve Chairman. This appointment sends a clear message, signaling a potential shift towards a more orthodox, perhaps even more hawkish, approach to monetary policy. Warsh is known for his keen understanding of market dynamics and a reputation for advocating for sound financial stability. His views will undoubtedly shape everything from interest rates to the Fed's balance sheet, and the market is already beginning to price in the implications of this new philosophy. Across the Atlantic, European Central Bank President Christine Lagarde continues to maintain a strategic silence on future interest rate decisions, a characteristic approach that keeps markets guessing. Meanwhile, in the digital asset space, Michael Saylor, the prominent figure behind MicroStrategy, continues to make headlines. Despite recent volatility in digital currencies, Saylor has doubled down, adding more digital assets to his company's holdings, signaling unwavering conviction in his leveraged crypto strategy. However, not everyone shares his enthusiasm, with notable commentators expressing skepticism about the inherent risks. The delay in the crucial U.S. jobs report due to the government shutdown only exacerbates the challenge for policymakers and investors alike, leaving a significant data void at a critical juncture. Turning our attention to the bedrock of global finance, the bond market is certainly feeling the tremors of this new environment. The yield on the benchmark 10-year Treasury note has seen a noticeable uptick overnight, reflecting a complex interplay of factors. Firstly, there's the immediate reaction to the new Fed chair, Kevin Warsh. His reputation as a proponent of tighter monetary policy and fiscal discipline suggests a potential for higher interest rates down the line, which naturally pushes yields higher in anticipation. The market is effectively beginning to price in a more constrained monetary future. Secondly, despite some delayed macroeconomic indicators, the underlying inflation narrative continues to simmer. While official CPI reports might be facing delays, anecdotal evidence and certain commodity price movements suggest persistent inflationary pressures. Bond traders are also watching the broader fiscal picture. The ongoing debate in Washington regarding government spending and the potential for a shutdown adds another layer of uncertainty, which can often lead to a demand for higher yields to compensate for perceived risk. There's a fascinating dynamic at play. Some analysts are even pointing to a historic Treasury short building, suggesting a belief among some large players that bond prices are set to fall further, pushing yields even higher. This creates a volatile environment where even small shifts in sentiment or rhetoric from the new Fed leadership could trigger significant moves. The implication for businesses and consumers is clear. The cost of borrowing could be poised for an upward trajectory, impacting everything from corporate investment to mortgage rates. The spotlight, undeniably, falls squarely on the Federal Reserve under its new chairman, Kevin Warsh. His ascendancy marks a pivotal moment for global monetary policy. Warsh's past statements and academic work suggest a strong inclination towards monetary discipline, price stability, and a cautious approach to unconventional policies. This could mean a more hawkish stance than what we've seen in recent years, potentially translating into a more aggressive approach to managing inflation and a willingness to tighten monetary conditions if necessary. The market will be dissecting every one of his initial remarks for clues regarding the pace and magnitude of future rate adjustments, and the potential unwinding of the Fed's substantial balance sheet. The Kansas City Fed's model-based natural rate of interest and natural unemployment rate will be more relevant than ever in this new regime, suggesting a potential return to more data-driven, academically grounded policy decisions. The looming partial government shutdown, ironically, complicates Walsh's immediate task, as critical economic data, such as the jobs report, becomes unavailable. This forces the Fed to rely more on market signals and less on official statistics, which introduces an additional layer of complexity and potential for misinterpretation. Meanwhile, in Europe, the ECB is grappling with its own set of challenges. Morningstar Canada has raised the question of whether the ECB will cut interest rates on February 5. This stands in stark contrast to the potential tightening we might see from the US Fed, setting the stage for diverging monetary policies between two of the world's largest economic blocs, which will have profound implications for currency markets and global capital flows. The commodity markets are painting a compelling picture of both stability and underlying tension this morning. Gold, the traditional safe haven, has experienced a significant rally overnight. This robust move suggests a heightened sense of caution among investors, potentially driven by the lingering geopolitical uncertainties, the ongoing discussions around global inflation, and perhaps a flight to safety amid the new, uncertain monetary policy landscape under Federal Reserve Chairman Walsh. Gold often shines brightest when there's ambiguity, and the current environment certainly provides plenty of that. Crude oil futures have also shown a positive trajectory. Despite headlines suggesting easing tensions, which might typically lead to a pullback, the underlying market remains firm. This can be attributed to persistent supply discipline from major producers, the anticipation of a gradual recovery in global demand as economic activity picks up, and the ever-present potential for renewed geopolitical flashpoints. The oil market often trades on sentiment and perceived risk, and while immediate tensions might subside, the structural tightness in supply continues to provide support. Natural gas prices, too, have edged higher. This is particularly interesting given recent reports of plummeting prices due to warmer weather forecasts. The overnight bounce in futures suggests a potential short-term correction after previous declines, or perhaps a reassessment of near-term demand dynamics as some regional weather patterns shift. However, the overarching narrative of ample supply and mild winter weather in key consumption areas still exerts downward pressure on the broader natural gas outlook. These commodity movements collectively underscore a market grappling with complex supply-demand fundamentals, geopolitical risks, and the overriding influence of evolving central bank policies. In the corporate landscape, the current earnings season continues to offer a mixed but insightful view into the health of various sectors. While the US market is currently closed, the futures movements of individual companies provide an early indication of market sentiment. Technology, as always, is at the forefront. We've seen some of the major names experiencing slight pullbacks or marginal gains. For instance, Apple has shown a modest positive move, possibly on continued strong product demand or positive analyst sentiment. Conversely, companies like Nvidia and Tesla are seeing slight dips, reflecting perhaps a pause after their significant runs or ongoing concerns about valuation and competitive pressures. Nvidia, in particular, often sees profit-taking after strong surges, and Tesla remains subject to intense investor scrutiny over production targets and demand. Microsoft, Amazon, Meta, and Google are largely flat or down slightly, indicating that even the tech giants aren't immune to the broader market's cautious mood. The narrative here is very much about selectivity. Earnings reports are proving to be key catalysts. While Palantir has jumped on strong earnings, providing a boost to some tech hopes, others like NXP and Disney have seen their shares fall after their respective reports. This reinforces the idea that investors are scrutinizing fundamentals closely, demanding clear pathways to profitability and growth. Pfizer, for example, beat profit estimates, underscoring robust demand for certain pharmaceuticals. The broader picture for sectors is one of discerning investors rewarding strong performers and punishing those who miss expectations or face significant headwinds. The digital asset space continues its journey of intense scrutiny and evolving narratives. This morning, both Bitcoin and Ethereum futures are showing slight downward movements. This minor correction comes as the market digests several key factors, including the broader risk-off sentiment that can sometimes accompany significant macroeconomic shifts, such as the new Federal Reserve leadership. Digital assets, while increasingly seen as an asset class in their own right, are not entirely decoupled from traditional market forces. A central figure in the corporate adoption of digital assets, MicroStrategy, is once again in focus. The company's valuation is being closely examined after recent fluctuations in the price of Bitcoin tested its leveraged crypto strategy. Michael Saylor, the company's chairman, remains a staunch advocate, reportedly using dry powder to add even more Bitcoin to MicroStrategy's war chest. This move signals unwavering conviction in his long-term thesis for Bitcoin, viewing dips as buying opportunities. However, this strategy is not without its critics. Veteran market commentators have expressed skepticism, questioning the prudence of such a highly concentrated, leveraged bet on a volatile asset. The debate around MicroStrategy encapsulates the broader discussion in the market. Is corporate adoption of digital assets a visionary move, or an inherently risky endeavor that could face significant challenges under a potentially tighter monetary policy regime? The market's reaction to MicroStrategy's stock, which has seen a slight decline, suggests investors are weighing these risks carefully. As we look towards the rest of the European trading day and anticipate the eventual open of the US market later, several key themes will dominate. The immediate focus for European traders will be on the continuation of earnings season, with particular attention to how companies are guiding for the next quarter amidst rising input costs and evolving consumer demand. Any surprises, positive or negative, could reverberate across global equities. For the US, even with the market closed now, the futures market will continue to reflect evolving sentiment. Traders will be keenly watching for any unofficial comments or leaks regarding the new Fed chairman, Kevin Warsh, and his initial priorities. The market will be searching for any indication of how he plans to tackle inflation, manage interest rates, and address the Fed's balance sheet. The delayed US jobs report will remain a crucial piece of missing data, leading to increased reliance on other economic indicators and anecdotal evidence. Furthermore, the political situation in Washington, particularly concerning the potential government shutdown, will continue to influence sentiment, adding a layer of uncertainty to investor decisions. Geopolitical developments, especially those impacting commodity supply chains, will also warrant close monitoring. Expect a day of cautious positioning, as investors continue to digest the profound implications of new leadership and uncertain macro conditions. As we conclude our morning update, the overriding narrative is one of significant transition and inherent uncertainty. The financial world is collectively holding its breath, adapting to the new era under Federal Reserve Chairman Kevin Warsh. His appointment represents more than just a personnel change. It heralds a potential philosophical shift in monetary policy, one that could prioritize discipline and stability above all else. This new landscape presents both challenges and opportunities. On one hand, we see a bond market reacting swiftly to expectations of tighter policy, and commodity markets reflecting a blend of fundamental supply, demand dynamics and underlying geopolitical tensions. On the other, the corporate earnings picture, while mixed, shows resilience in certain areas, underscoring the innovative spirit of capitalism. The digital asset space, exemplified by MicroStrategy's continued conviction, remains a fascinating frontier, though one now viewed through the lens of a potentially more restrictive financial environment.